In this video, I'm going to show you how I increased my client's legacy by over $5 million using actuarial science and the stock market. And I was able to do this because professionally, I'm a life insurance strategist who in various ways protects families, preserves capital and wealth, and provides stability to your overall portfolio. So everything that I say in this video should not be taken as investment advice or financial advice. If you're going to take action on anything, be sure to consult with a professional in your area or somewhere around the nation in order to make any significant changes to what you got going on. So let me give you a little bit of backstory on this client. He wanted a couple of different things, and the first thing that he wanted was asset class diversification, and the second thing that he wanted is to make sure that he's able to leave a legacy to his family, whether he dies earlier in life or if he dies when he's 112. He didn't want something that was going to expire. And then going back to the asset class diversification, he understands that from a retirement income standpoint, he knows that like if he has all his eggs in one basket, it's probably not going to be the best thing for him. He knows that ultimately right now, where most of his dollars are stored is in the stock market, and he has nothing necessarily safe to fall back on, nothing necessarily safe to tap into during those retirement years. So how do we increase my client's legacy by over $5 million? Let's start off with the trajectory of his retirement assets. We kind of came to the conclusion that conservatively, he'd be at around $3.2 million by the time that he's 60 years old. And that's the year that he wants to retire. And we all know that the market is going to fluctuate. It's going to have its ups and downs. And really how that pans out is like 1 out of every 3 or 4 years or so, the market is going to have a down year. When the market does have these down years, during an accumulation phase before you reach retirement age, it doesn't really hurt that much because you don't necessarily need the money, but it can wreak havoc on your plan once you need that money in a retirement distribution phase. So when you go from having a paycheck every week or every couple of weeks to then needing to distribute your assets, essentially spend them down, that's a completely different way of looking at things. And so those ups and downs of the market are going to hurt a lot more. And this is something that's called sequence of returns risk. Now, I'm not going to get into the nitty gritty of sequence of returns risk. If you want me to go through a video on that, if you care about it, go ahead and type sequence in the comments and I'd be happy to make a video on that. And a way to offset this is by having some sort of a safe asset that you can tap into during those years or the year after the market had a really bad year. Therefore, your stock market based assets have some time to recover and get back to where they were and potentially past it. All right, so let's head over to my computer. I'm gonna share my screen and I'll show you some numbers. All right, so in the case of my client, we use hypothetical returns of real historical S&P 500 returns from back in the 70s. And so there were 3 scenarios that we painted for us. There was the investment only scenario, there was the investments first scenario, and then there was the insurance, right, using the safe asset class after down years in the market. All right, so here's how it played out. When my client is 60 years old, which is the year that he wants to retire, we're seeing that in that particular year, that first year that he retired, the market was down over 17%. And we're seeing that there's $146,000 and you're seeing pre-tax and after-tax withdrawals. This is pre-tax because the account that he's going to be drawing from so happened to be an account that's going to be taxable, right? And so the true results of that will end up being $124,000, and this is actually pretty conservative. We were just accounting for a 15% tax rate, which really it could be a lot higher, but I was just going off of, for example, long-term capital gains. So it could be way worse if you're talking about from 401ks and IRAs, because those are going to be taxed at ordinary income tax rates, which could be significantly higher depending on where we're at when he's 60 years old. And so what we're seeing here is that his account went from $3.2 million to start to by the end of his first year of retirement, we're looking at $2.5 million. That's a significant drop and might kind of make your stomach drop as well when you think about my money may not last as long as I wanted it to or as long as I thought it would. And what we're seeing in this particular scenario when you're only using investments is that he ends up running out of money by the time that he's 81 years old. So what happens when we shift gears a little bit? Let's say we're looking at, for example, the scenario where you take out all of your investments first. And so ultimately it's the same as the first one, except you have another asset to tap into afterwards. And so by that same age 81, he runs out of his investment assets, his market-based assets, and then from there he taps into his life insurance, right? The beauty of tapping into the life insurance is that you don't have this pre-tax and after-tax sort of idea to deal with. The reason for that is because life insurance, when you access those dollars, are tax-free. And so he's been able to take out that money until the age 89, which is what I wanted the software to be able to tell us. By that age 89, he's, instead of leaving $0 if he lived that long, he's going to end up leaving $1.7 million because of the fact that he's coupling his investments with life insurance, right? This is just pure, essentially, death benefit that's going to be paid to his beneficiaries by that time. But it gets even better using life insurance cash value in the years where the market doesn't do well, or more specifically, the year after there's a down market. And so what we're seeing here is the same exact numbers from the S&P 500, right, as you saw in the other pages. But let's just look at this first year, for example. First year, negative 17%, he still took that money out, kind of ends up where he was before. But then in that following year, in order to allow his market-based assets to recover somewhat, or recover fully in some cases, what we're seeing here is that he takes income from where? His life insurance policy's cash value. But you're seeing that it's actually a smaller amount of income, again, because of what? You don't have to worry about the tax rate, so there's no pre-tax and after-tax ideas to deal with, because with life insurance, you get to draw income tax-free. And so this continues throughout every single year that there's, well, after the year that there's a down year, you draw from your life insurance policy, right? I hope that makes sense. And so then by that same age 81 from before, what we're seeing is instead of him leaving $0 in terms of total assets left if he died by that point, he would leave over $5 million, quite literally. Why? It's because he has his death benefit, right? If we scroll up to the top, we're seeing that this is the net death benefit. So he has his death benefit here, in addition to the fact that he allowed his market-based assets to not just dwindle, but recover multiple times throughout that 30 years time frame. And let's say he lives even longer, to that age 90, for example, or age 89. He then would end up leaving over $6 million to his family in the event of a death. So it just goes to show that what people think to be true doesn't always pan out to be true. And I think one of the biggest reasons behind that is because we just haven't done the math on things. And by using life insurance as a volatility buffer, the legacy that you end up leaving could be significantly greater, just like my client who went from leaving $0 to over $5 million. And if you want to learn more, discuss your situation more specifically, and create a life insurance strategy for you and your family, go ahead and click the link in the description, or maybe there's a pinned comment, and I'll be more than happy to speak with you for free. Thanks for watching.